Maybe the problem isn't the asset you chose. Maybe it's how you react to it. Do you buy out of excitement and sell in a panic? If so, the market isn't to blame. Your mind is. I'm Chad with Zero Markets, and in this video, you'll learn how your emotions may be sabotaging your portfolio. We'll talk about anxiety, greed, fear, herd mentality, and other psychological biases that affect your decisions. But it's not just theory. I'll show you what to do in practice to avoid the mental traps that are destroying so many people's performance. Subscribe to the Zero Markets channel here, leave a like, and let's get to the content. The modern investor has access to more information than ever before. But even with all the data on the screen, many continue to buy at the top and sell at the bottom. Why? Because the information is on the screen, but emotions are in control. In times like these, with frustrating interest rates, with wars, elections, and economic uncertainties, the emotional factor becomes even more dangerous. According to a study by Dalbar, individual investors historically underperform the fund they invest in, precisely because they make decisions driven by emotion. Many people look at the market fluctuations and think that the problem is it's going up and down, but the real problem is how you react to it. Fear makes you sell good assets at the wrong time. Anxiety makes you anticipate moves that don't materialize. A study of investor behavior in 2008 showed that those who sold during the crisis and didn't get back in afterward missed one of the biggest bull cycles in history. The other extreme is also dangerous. When you get into an asset that keeps rising, you feel like a genius. You start to ignore risks and double down. This is the cycle of greed. You'll feel like you have to get in or you'll be left out. But those who buy at the peak of euphoria almost always end up taking a loss later. Classic example, the crypto rush in 2021. Many people got in without understanding anything, just because everyone was winning, and they ended up losing money. Guys, we're social beings, and this impacts the market. When everyone's going in one direction, we tend to follow them, even if we don't fundamentally agree with them. Herd mentality is one of the most destructive forces for an investor. It makes you enter and exit positions based on noise and headlines, not on analysis. A real-life example, when an influencer talks about an asset and it skyrockets, the asset hasn't changed. The collective perception driven by a leader is what changed. The best way to deal with emotions in the market isn't to pretend that they don't exist, because they will appear. Fear, euphoria, doubt, impatience, all of that is natural. The difference between an amateur investor and a professional is that the professional creates a system that works even when they're emotionally shaken. They don't have to be calm to make a good decision. The system takes care of it. Let's talk about some practical strategies to help you create this long-term mindset. Number one, have a written investment plan. It's not enough to rely on memory or intention. You need a written plan. In it, you need to define your goal, your timeline, what types of assets you'll buy, what percentage of the portfolio goes into each class, and most importantly, when you buy and when you sell. This plan is what keeps you steady when the market starts to shake. It's like following a GPS in the middle of a storm. If you don't have one, you'll end up making impulsive decisions. Number two, set loss and profit limits before entering the trade. Before you click buy, you need to know, if this asset drops by X%, I'm out. If it goes up by Y%, I'll take a profit. These limits are your emotional brakes. They prevent you from trading your portfolio based on the heat of the moment. Without this, the risk of turning a small loss into a huge one just out of pride or stubbornness is extremely high. Number three, use DCA, or dollar cost averaging, to dilute emotions with regular contributions. DCA means investing a fixed amount at regular intervals regardless of the price. With this, you reduce the risk of entering at the top, avoid the temptation of trying to time the market, and build consistency. It's a way to put discipline on autopilot. And when the market fluctuates, you don't panic. Your system is already running. Number four, follow the market less, but with higher quality. Constantly checking the prices every 10 minutes will only fuel anxiety. Instead, choose good information sources, set a specific day, a specific time each week to review your portfolio, and use that time effectively. Most bad decisions come from overexposure. If you stay informed with focus and regularity, your chances of acting rationally increase significantly. Number five, always reflect. Is this a rational or an emotional decision? Every time you're about to make a move in the market, stop and ask, am I doing this because I've analyzed it or because I'm scared? Am I selling because I've changed my thesis or because I'm insecure about the drop? This simple question can save you from so many mistakes, because in the end, investing well is more about discipline than about prediction. It doesn't matter if you have the best analysis in the world. If you don't have emotional control and a clear plan, the market will take you out of the game sooner than you think. The market will always fluctuate, but what truly defines your result is how you react to it. If you want to become a better investor, you have to start with your mind. If this content made sense to you, please subscribe to Zero Markets channel here. Leave us a like and share it with someone you know who needs to hear this. And comment below, what emotion gets in the way of your investments the most today? Is it fear? Is it greed? Is it insecurity? Let's talk.